Let me ask you something, and I want you to be brutally honest with yourself when you answer. Do you actually know when your money will double? Not roughly, not someday, not when the market cooperates. I mean the exact year, the exact time frame, down to a decimal point. Because if you can't answer that, you're not investing, you're gambling. And gambling is something I have absolutely no patience for. I've built companies, I've sold companies, I've been on the other side of the table from every kind of investor you can imagine. And I will tell you right now, the ones who win are not the ones who get lucky. They're the ones who understand the math. So today, I'm going to give you the most powerful single tool in the entire world of personal finance. It's called the Rule of 72. And once you understand it, you will never look at money the same way again. Here's the reality. Most people treat investing like a lottery ticket. They throw money into a fund, they check their app every 3 days, they celebrate when it goes up, and panic when it goes down. That is not a strategy. That is noise. And noise is what keeps average people average. The investors I respect, the ones who have actually built real wealth, they operate on a completely different level. They think in systems. They think in timelines. They think in mathematical certainty. The Rule of 72 is part of that system, and it's so simple that it almost seems too easy to be worth anything. That's exactly why most people dismiss it, and that dismissal is exactly why most people are broke at 65. So here's how it works. You take the number 72 and you divide it by your annual rate of return. The answer tells you how many years it will take for your investment to double. That's it. No spreadsheet, no financial advisor, no $100 software subscription. Just arithmetic. If your portfolio earns an average of 10% per year, which is roughly what the S&P 500 has historically delivered over long periods, you divide 72 by 10 and you get 7.2. That means in just over 7 years, every dollar you put in becomes $2. Your $10,000 becomes $20,000. Your $100,000 becomes $200,000. And you didn't do anything. You didn't pick individual stocks. You didn't time the market. You let math do the work. That is what discipline looks like. Now, let me tell you something that most people in this industry won't say plainly. The origin of the Rule of 72 is traced back centuries to the mathematics of compound interest. Some scholars attribute early versions of this concept to Luca Pacioli, a 15th century Italian mathematician who worked alongside Leonardo da Vinci. Pacioli recognized that money growing at a fixed rate follows a predictable doubling pattern, and he built early financial tables around this principle. Later, Albert Einstein reportedly described compound interest as the eighth wonder of the world. Whether that exact quote is precisely attributed doesn't matter. The underlying truth is undeniable. Compounding is the most powerful force available to an ordinary investor. And the Rule of 72 is the fastest way to visualize it. Here is where things get genuinely interesting and where most people completely miss the boat. Let me show you the difference between a 7% return and a 12% return, and I want you to pay very close attention. At 7%, you divide 72 by 7, and you get a doubling time of approximately 10.3 years. Fine, reasonable. Now at 12%, you divide 72 by 12, and you get exactly 6 years, 4 fewer years to double your money. That sounds like a minor difference until you think about it across a 30-year investing horizon. At 7%, if you start with $100,000 today, after 30 years, you've roughly doubled 3 times, ending near $800,000. At 12%, you've doubled 5 times in that same period, and you're looking at well over $3 million. Same starting capital, same 30 years, a difference of more than $2 million from 1 percentage point. That is why I obsess over returns. That is why I have no patience for people who leave money in savings accounts earning 0.5%. And since we're talking about savings accounts, let me introduce you to the reverse side of this equation, because the Rule of 72 is not just your friend. It can also be your most dangerous enemy, depending on which side of it you're standing on. Inflation. Let's talk about inflation. When inflation runs at 3%, you divide 72 by 3 and you get 24. In 24 years, the purchasing power of your cash is cut in half. Your $100,000 in a savings account, after 24 years of 3% inflation, will only buy you $50,000 worth of goods in today's terms. And if inflation spikes to 6%, as it did in recent years, your purchasing power halves in just 12 years. Your cash isn't sitting there growing. It's being eaten alive. Every single day you leave money uninvested is not a neutral act. It is an act of slow financial destruction. This is the trap that catches middle-class families generation after generation. They save diligently. They feel responsible. They put money in the bank and they feel safe. But that safety is an illusion. The banks take your deposits and invest them at returns you will never see. The institutional investors sit at tables you're not invited to, and while all of that is happening, your savings account is losing ground to inflation every single month. The rule of 72 is how you wake up to that reality. It is a flashlight in a very dark room. Here's how I want you to start using this tool practically. Every time someone pitches you an investment, every time you're evaluating where to put your money, run the rule of 72 before you commit a single dollar. If a product promises you 4% per year, divide 72 by 4. Your money doubles in 18 years. Ask yourself if that timeline works for your goals. If someone promises you 24% per year, divide 72 by 24. That's a doubling every 3 years. Does that sound realistic? Sustainable? Because I will tell you from personal experience, returns that high, sustained over many years, are almost always accompanied by risks that are not being disclosed to you. The rule of 72 is also a red flag detector. If a return sounds too good to be true, the math will usually tell you why. Let me talk about expense ratios for a moment, because this is something that drives me absolutely crazy when I see retail investors ignore it. An expense ratio is the annual fee charged by a fund to manage your money. The average actively managed fund charges between 1% and 1.5% per year. A low-cost index fund charges as little as 0.03%. Suppose you're earning 10% gross on your portfolio. A 1% expense ratio takes your net return to 9%. At 9%, your doubling time is 8 years. At 10%, it's 7.2 years. Over a 40-year career, that 0.8-year difference adds up to roughly one additional complete doubling of your wealth. One more doubling, because someone charged you an extra 1% per year to underperform the index. Every basis point matters. The rule of 72 proves it. Let me give you a real-world example. Berkshire Hathaway has delivered an average annual return of roughly 20% over several decades. At 20%, divide 72 by 20, and you get 3.6 years for your money to double. Buffett has been compounding at roughly that rate for 60 years. He didn't trade daily. He didn't predict macroeconomic cycles with perfect accuracy. He understood the math of compounding deeply, and he let time do the work. The rule of 72 is that math in its simplest, most accessible form. Now I want to address something directly. Some of you are going to say, Kevin, I'm starting late. I'm 45, I'm 50, I don't have 30 years. And here's what I say to that. If you're 50 with $100,000 invested and you earn 10% annually, in 7.2 years you have $200,000. At 57, you're sitting on $400,000. At 64, $800,000. Those are real achievable outcomes based on math that has been proven over centuries. The question is never whether it's too late to start. The question is how much longer you're willing to wait before you do. I also want to address debt, because the rule of 72 works against you with debt just as brutally as it works for you with investments. If you're carrying credit card debt at 24% interest, divide 72 by 24. Your debt doubles in 3 years if you're only making minimum payments. In 6 years, it has quadrupled. Most people look at their credit card statement and think about the monthly payment. They should be thinking about the doubling time. They should be horrified. The fastest investment you can make is paying off high-interest debt, because the return is guaranteed and compounding in your favor the moment you eliminate it. Money has no emotions. Debt has no mercy. The rule of 72 does not care about your feelings. It only cares about the numbers. Here is my final thought, and I want you to take this seriously. Financial literacy is not optional in the modern world. It is a survival skill. The gap between people who understand compound interest and people who don't is not just a wealth gap. It is a freedom gap. The people who understand this math have options. They can retire early or choose not to. They can evaluate any financial product in 30 seconds using simple arithmetic. The people who don't understand this math are permanently at the mercy of the people who do. Stop being a tourist in the market. Stop wandering through your financial life hoping things work out. Learn the rule of 72. Apply it every single time you make a financial decision. Calculate your doubling time today. Know your number, and then go to work on improving it. That is not a suggestion. That is the only rational way to build wealth in a world where money never sleeps and math never lies. Take out your phone right now. Open your portfolio. Find your average annual return. Divide 72 by that number. That is your doubling time. If you don't know your average annual return, that is the first problem you need to solve. If that doubling time is longer than you're comfortable with, subscribe to InvestIQ Global, because we are going to work through every tool, every strategy, and every framework you need to compress that timeline responsibly and intelligently. The math is simple. The discipline is what separates the investors who win from the ones who merely participate. Now go run your numbers.